Hey there, everyone. Today on the Final Bar, we'll wrap this week. We'll talk about higher interest rates, keeping growth stocks at bay. The S&P and the Nasdaq essentially finishing flat for the day. The energy sector makes a new swing high on higher crude oil prices. And we'll crack open the Final Bar Mailbag. How can you best chart the relationship between price and volume? Ladies and gentlemen, this is the Final Bar. Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of StockCharts. The StockCharts platform was designed about 24 years ago to empower online investors, individual investors, to better understand the markets using the technical analysis toolkit. And StockCharts has evolved over time. We have a lot of different people doing a lot of different things that are using our platform, but they have one sort of consistent goal in mind, and that's to better understand the markets. And I would argue that a consistent application of the technical analysis toolkit, while it won't give you a crystal ball to know where things are going to be tomorrow, none of that exists, to be honest with you, with any discipline. What it does do is prepare you to make better decisions. And that's what we want to try to empower you to do through the show, where we cover the market action and try to connect the short-term movements with the long-term trends. And we've talked about a lot of these themes. We had some great guest conversations this week. We had T.J. Watkins in the studio yesterday. He talked about that disciplined approach to technical analysis, but also focusing on the evidence. So let's see how the evidence has evolved, what we learned today, and also some really good mailbag questions. Talking about volume, kind of an unintentional volume focus. So we'll get to that a little later. Let's start with our Wrap the Week segment. We'll look at what happened today, this general progression, and then we'll connect it to the big picture. To start us thinking in the big picture mindset, we'll take a poll question we asked on our social media accounts here recently. We asked you, where will the S&P 500 be as of December 31st, 2023? Above 4,800, which would be a new all-time high, as you probably know. Between 45 and 4,800, 42 and 4,500, or below 4,200. The most popular answer, although a pretty decent spread between the top two, was between 4,500 and 4,800. Let's check out a chart of the S&P 500, see where that actually fits into where we're at right now. So right now, I guess in the last couple months, or we'll call it the last 6 to 8 weeks, we've been locked in this range between 4,600, which is that peak from July, 4350, we'll call it, right? Which is sort of the low in June and then the low again in August. So 4,500 to 4,800 means we're basically between current levels and the all-time highs, which would be back off the left side of the chart from the end of 2021, beginning of 2022. 30% of you, almost 1 in 3, said we make a new all-time high at year-end, or at least we've done. We close above there at the end of this year, which means my bears, which would be less than where we're at today. Not many of you, quick math, what, about 35%, about 1 in 3 saying we'd be below current levels. So pretty lonely there in the bear camp. I think what's interesting to think about, and the reason why I think that poll question is important, it's not necessarily to imply that you should know the answer to that, right? That is an unguessable. I mean, you can guess, but it's unknowable, right? We don't know what's going to happen over the next 4 to 5 months, right? But it's more guesswork. But what I like about it is it forces you to think about what the future path of the S&P may be. Remember, if we do finish the year at around 4,600, which would be right around the July high, there could be a lot of things that happen between now and then that get us to that point, right? We could go down to 3,800 and then back up and have a strong fourth quarter to get back up to that point. So thinking about the fact that there are a lot of different potential paths, thinking about how you would manage risk and identify opportunities in those different environments, I think is a really helpful exercise. So look forward. Don't think that you have a future, perfect crystal ball, but certainly think about how that can prepare you. So then when something happens tomorrow, you've already at least thought through that potential scenario. So thanks for asking that poll question. As a reminder, make sure you subscribe to our YouTube channel. You won't miss the next poll question for sure. Let's check out what happened in the markets today. What we like to do on Fridays is just check in on the action on Friday's session, look at the week overall, what we call the Wrap the Week. Let's focus on what happened from last Friday to this Friday, and then we'll look at some opportunistic ideas, some higher level macro charts that tell the story of where we're at. The major average is essentially flat for the day, and if you look, kind of a choppy session, a bit of a rally there in the last hour, but overall, the S&P and the Nasdaq essentially unchanged from Thursday's session. Now, I think that is a meaningful takeaway because we did get additional economic data, and I think the general sort of vibe of this market is bad news is good, good news is bad. And what that means is what the Fed is trying to do is slow down the economy. They've been raising rates, and for now, we'll see what they do at the September meeting. But assumptions are that they probably are done raising rates for now. So are the actions that they've taken so far in the first half of 2023 enough to slow down the economy enough that inflation comes down? This is why rates are going up. This is why inflation is coming down to more manageable levels, and the economy is being slowed down by essentially making rates a lot higher. So the question is that holding? So the worst economic data we see today implies that the Fed doesn't have to hike rates anymore because the actions they've taken so far are enough to sort of engineer that soft landing, that Goldilocks scenario that so many, I think, are hoping for. The fact that we did get additional economic data and the markets didn't rip to the upside tells me that there's, how much is already priced in quite a lot, right? I think the market is pricing in sort of this soft landing. And again, the concern I would have is we are one really good economic data point away from things getting pretty ugly. I would argue if all of a sudden it looks like there's a need for the Fed to step in and be a little more aggressive in the second half of the year, I think that's when risk assets can rotate lower. So for now, no real change. The S&P finishing the day around 4516. The Nasdaq Composite staying above 14,000, around 14,032. Mid caps and small caps up, and the small cap S&P 600, one of the best performers today, up just below 1240 for the small cap S&P 600. That's up about 1% from yesterday's close. The VIX down a little bit more, down about a half a point. So we're testing that 13 level. We're now right about at the lowest levels we've seen in 2023. Now, these are not all-time lows. If you go back for the last 10 years, you'll find times when the VIX is a little bit lower than this, but we're certainly getting in the lower end of the range that is theoretically possible, right? There's a normal level of volatility. It's because shares are changing hands in whatever market you're looking at. There is some volatility. It's just, is there low volatility or high volatility? This is a very low volatility environment as the VIX getting back down to some of the lowest levels we've seen in a number of years. Now, part of the story today, and I think one of the bigger themes we've been hitting on a lot on the show is higher rates, higher interest rates, and essentially rising rates. The 10-year yield is around 4.17% today. Long bond yields around just below 4.3%. Same about level for the 5-year yield. One of our mailbag questions, by the way, asked about why these are quoted this way. I did some digging to prepare for the show, and that question, which I'll share with you when we get to the mailbag, we'll talk to you about how those yields are quoted. But essentially, 4.3% for the long bond yield, 4.17. The dollar index up about 0.6%. Today as well, and that might be an important chart to watch going into next weekend. As a reminder, Monday, of course, markets close for the Labor Day holiday long weekend. We'll be back with the live show on Tuesday. Looking at the commodity space, the DBC is up 1.2%. Gold essentially flat. Silver down about 1%. Crude oil prices pushing higher. The USO, which is a crude oil ETF, up 2.5% today. The energy sector pretty strong, threatening a new high for the cycle, to be honest with you, new all-time high for the XLE. We're not quite there, but we're getting closer and closer on a day like this. Higher energy prices mean higher energy stocks more often than not. But broadly speaking, commodities kind of mixed. We dug into commodities a little bit on yesterday's show. We looked at the chart of gold and crude oil. So if you missed that, make sure you go back to the replay. Probably worth reviewing if you haven't paid a lot of attention here. Cryptocurrencies continuing to weaken. I had a really good question, a really good discussion with Adrian Zadunchik on the show on Wednesday. Another great one to review. And we talked a lot about the overall environment, really the longer term thesis for cryptocurrencies. You know, my challenge, I think one of the challenges for a lot of investors, for me and others, is just the volatility in this space, right? So when Bitcoin and Ethereum are up or down, they are occasionally up or down slightly, but it's usually more of a high volatility move. They're up a lot and down a lot. You see a lot of red today. So Bitcoin down about 1.5%. Ether prices down about 1.8%. Ether now just above 1,600, and Bitcoin now below 26,000, around 26,560, we'll call it. Just to finish off today, let's look at the sectors. As I mentioned, the energy sector by far outperforming the rest of the market, up 2% today. Materials number 2. We haven't mentioned that sector in a while. It's been kind of in the middle. It's been one of those middle of the road type of sectors, but up about 1.1% today, followed by financials and industrials. At the top, you have those cyclical kind of value-oriented sectors. Most of these are what I call the MEI stocks. materials, energy, industrials. They don't all move the same by any stretch, but similar kind of ideas, similar types of businesses, more established, more value oriented. These are not explosive growth industries. These are more blue chip type of stable, higher quality stocks, but definitely getting it done today on Friday. We haven't seen all of these sectors at the top of the daily returns list in quite some time. The sectors getting hurt today: communications services, the XLC, down 1%. Consumer staples down 0.9%, and consumer discretionary and utilities both down about 0.5%, 0.6%, we'll call it. Let's check out a chart of the S&P 500. I mentioned in the poll question about where the S&P will be. I actually didn't answer that. At the beginning of the year, I feel like I said around 4,400. I probably would stick to that. I haven't seen enough to change that opinion yet. And I guess what would tell me to change is if we continue to go higher. Obviously, I mean, at some point you have to think about the expected strength in the fourth quarter. Fourth quarter tends to be pretty strong for stocks. So I think the weakness we may see would be sort of in the August-September range. I think we saw the beginning of that in August. I don't think we're done with this corrective phase just yet. But weeks like this, where we just blow right back above the 50-day moving average, give me a little bit of pause to that thesis. But I think there's more backing and filling to be done before we can signal any sort of all clear in here. And the question is just how much of a pullback do we have? What sort of opportunities that present? And then how much of a buying run do we have at the end? I think a lot of that will have to do with the interest rate environment and what the Fed does between now and year end. I think for now, pausing rate hikes is the most likely scenario here. And that's what I would be expecting. Worth noting, by the way, I've mentioned on the daily chart of the S&P, the RSI, this is one of those times where I think it's pretty important. We're stalling out for now just below 60. And in a bearish environment, the RSI rarely gets above 60. And that's why I think that might be an important level to watch here. After we've had that initial bounce off of the initial drop, so we have the drop, the initial bounce higher. Does the momentum get above 70? That would be one of the more bullish developments you could imagine, which would mean that there's plenty of buying power coming into to the market. Coming out of the holiday weekend, we'll see where things are at for sure. Let's go to what we call the wrap the week chart. This is looking at the weekly returns in some major asset classes using mostly ETFs. We're starting the clock at last Friday's close and just looking to see how these markets have evolved over time. In black is the S&P 500, finished the week up 2.6%. Decent up week, and particularly given what happened in the first half of August, the fact that we're seeing this renewed strength in the second half of August now into early September, pretty noteworthy. So a series of weeks like this certainly causes the chart to go higher and reinforces that uptrend that I've discussed with a number of my guests recently. Here, outperforming the S&P this week, up about 3.7%. We have two different ETFs. The IWM is in purple. That's small cap, the Russell 2000 ETF. The QQQ, the NASDAQ 100 in pink. So both of those almost identical returns, up about 3.7%. Crude oil, the biggest winner. The USO finished the week up 6.2%. Talked about the opportunity with energy stocks as a quick teaser on Monday. We're taking off for the Labor Day holiday, but Grayson Rose and I sat down earlier this week, recorded a special episode called the Top 10 Charts to Watch for September 2023. Make sure you check that out on Monday because energy certainly came up and we talked about that. So seeing some of the strength that Grayson and I were talking about during that special recording. Everything else kind of underperformed the S&P this week. In orange, we have the Emerging Markets ETF, EEM, which was up still around 1.9%. Gold prices higher by 1.4%. A couple things unchanged for the week, essentially. The dollar, and in red, we have bond prices, both essentially flat, not much change, even though there's some volatility. At the end of the week, really didn't make any ground. Bitcoin was up big around Tuesday, Wednesday, finished the week in a position of weakness, down 1.7. So not a horrible week, but certainly giving up a lot of those recent gains here in the last couple days. Finishing off our Wrap the Week segment, let's go back to the dashboard, and I have some of these charts sort of set up here, and this is where I wanted to go. Our market trend model is here on the left. As you can probably see from the chart, there is a change. The long-term model has remained bullish now for quite some time, turned bullish in the beginning of April, really end of March of this year, has remained constructive. Really just speaks to the strength, long-term strength perceived by the rally here in 2023. My medium-term market trend model has been bullish essentially since November. Had a couple multi-week brief stints below the zero line, but overall, it's basically been a risk-on indicator. And for me, this is my most important one. As long as that's above zero, I feel pretty comfortable taking on additional risk, finding good opportunities. When it's below zero, I just tend to think a lot less about upside opportunities and more about downside risk and making sure you're preserving capital for the next bullish phase. So overall, it's been saying essentially risk on here. And even with the drawdown that we saw over the last month or so, still remaining bullish on that time frame. Now, the short-term model did turn down when that pullback occurred. As of today, the strength that we saw through the course of this week, turning that short-term model back bullish. So as of today, my market trend model bullish on all three time frames. That tells me to be comfortable, long, and strong. I don't know if I feel comfortable with that particular assessment, but I have learned to trust the model. Just like when you're flying and you're taught to trust your instruments. There's your dashboard, right? The dashboard in your Cessna is saying conditions are good. So I'm going to assume that they are until the radials tell me something different. For now, they're okay. Finally, this is a chart simply called The Chart, and it combines some of the key takeaways that I like to look at to understand just the market conditions at a high level. The S&P overall is going higher, and that's where I just want to start any discussion with this sort of chart looking at breadth indicators, is the trend in the market is still positive. And even though we pulled back, I mean, the long-term, medium-term view is still constructive in my opinion. I think the S&P has to get below 4,200 before you really start thinking about negativity and defensive positioning. Between here and there's a lot of wiggle room that you can have in an uptrend. I think that's still the phase that I would consider us in. The advanced decline line actually found support at a similar trend line. The NASDAQ composite found a similar support at that same trend line as well. Percent of stocks above their 50-day moving average, almost right at dead neutral 50%. It's just below, still around 48%. I think that might be an important chart to watch here. It would be very interesting if we drop, we rally, and then the next leg lower, and this indicator never gets above 50%. Might be interesting to look for. The bullish percent index, which shows you point and figure charts for the S&P 500, what percent of them are in a bullish phase. It's still over half, it's around 58%, which is still a bull market number. This ratio is an important one, and Adrian Zidunchik on Wednesday, great points on offense over defense. His point was on a higher level, offense is still outperforming defense, and I'd have to agree. This ratio is not going down. It's at worst sideways here over the last month, and at best, it's just a pullback within this uptrend, and I wouldn't be inclined to trust that ratio as a measure of risk assessment. Overall, it's telling me conditions are okay. Just to finish off here, a couple charts to highlight to wrap up our Wrap the Week segment. The XLE I'll highlight here, testing new highs. This is a great point to just remind you that when you bring up the XLE on our charts, it's actually looking at adjusted data, meaning it's smoothing out all of the dividends. Something like the XLE, the energy sector, tends to be a little higher dividend payer. So what you want to do is put an underscore before the ticker. That will actually take the adjustments out. Now you can see that we're actually still below all-time highs here. The long-term highs around 93 to 95, we'll call it. Now that was the peak in June of last year, in November of last year, and also February of this year. We're getting close, but we're not quite there. Could be setting up for a nice breakout. And if that would occur, this is a big base. And Ralph Acampora, one of my mentors, would always say, the broader the base, the higher in space. So the longer and the wider this basing pattern has been, the breakout becomes more and more meaningful. I think energy really close to that sort of breakout. Finally, be warned, and I'll bring up the ACP platform for this one. Tesla bouncing up to the 50-day moving average and failing. I was thinking of this as I was looking at stocks that were rotating lower today. Tesla down about 5% today. Rough day for a stock that obviously is on a lot of people's radar, part of the Magnificent Seven, and rallying off of the swing low from a couple weeks ago, failing to regain the 50-day moving average. Traded up to it earlier this week, chopped around there a couple days, and now coming right back down. I think that might be a really important chart to watch, among others, going into next week. We have to continue on the show here in a moment with our mailbag. Before we do that, a couple quick announcements. First off, we welcome your feedback on our show. We've been making a lot of hopefully really good changes. Really cool to be back live, but a big part of the show is interacting with all of you. I'd love to see and hear your questions. We'd love to feature one of your questions in our next mailbag segment, which will be on next week's one of next week's episodes. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. On X, just tag us in a comment at Final Bar SCTV. And of course, on our YouTube channel, just drop a comment below the video that you're watching. While you're there, make sure you subscribe to our channel. Drop us a like if you could as well. Give us your question and we'll make sure we answer it, hope to answer it in our next mailbag segment. Also, as a reminder, we do a weekly live show on our YouTube channel every Wednesday at 1 p.m. Eastern, 10 a.m. Pacific. We had a great Q&A this last Wednesday. We'll do it again next Wednesday. So on our YouTube channel, you'll find the event that's set up for next Wednesday at 1 p.m. Eastern. Make sure you tune into that live Q&A as well. Let's open up the Final Bar Mailbag, see some of the questions that we've received. A couple of these, by the way, came from our live Q&A last Wednesday. We didn't have time for all of them. Here's question number 1. Dave, how would you compare Chaikin Money Flow and the Accumulation Distribution Indicator? There's and I will tell you right off, there's kind of a volume theme to the mailbag today, and I don't intentionally do that. I sort of bring some of the most recent questions, and of course, find ones that I think would be helpful for everyone to hear the answer to. A lot of volume questions came in recently, so we're going to hit that topic a little harder than normal. You're asking about two indicators, which are really improvements on other indicators. So one of the basic ways you can think about the movement in price and what that movement represents is by looking at volume. And I was taught from Edwards and McGee and John Murphy and Martin Prink, sort of those foundational books on technical analysis early in my career, that a big move in price on heavy volume is to be trusted a lot more than a big move in price on lighter volume. Because the heavier volume implies that institutions, the smart money, the well-informed investors are actually pushing the price as opposed to, uninformed or underinformed retail investors was the implication. And I think that was true 50, 70 years ago because as an institutional investor, you just had access to more information. You could get inside information because the regulations were not as specific or certainly not as enforced. And so there was an advantage to running a big fund and having a lot of access. A lot of those advantages have disappeared because now you have more information at your fingertips than any institutional investor probably did 50 years ago. I mean, we have so much data that we can actually consume, and I think that presents all sorts of other problems. Having said that, the price-volume relationship is as I implied. Looking at daily volume readings, however, can be a little misleading because you're just looking at one day and one volume bar. So there are a lot of tools that have the ability of stretching or looking at trends in volume over time. This chart that I'm showing you, this is UNH, United Health Group, over the last 2 years. The indicator right below price is called on-balance volume. Now, this was Joe Granville, who was a popular strategist in the 70s, I want to say, right? 60s, 70s, 80s-ish. I'm sorry, I don't know the exact dates when Joe Granville was around. I want to say 70s is what comes to mind. But Joe Granville was a very engaging presenter from what I've been told. And he basically improved on a daily just volume reading by looking at volume over time. And what he would say is, if the day was a down close, you subtract that day's volume from a running total. If it was an up close, the close was higher than yesterday, you would add that day's volume. And so on-balance volume is just basically saying, was the day an up or down close? Let's put the volume on there, and then you look at it over time. So instead of looking at a daily volume reading, you're seeing the trend in volume. So price is going higher, on-balance volume is trending up. That means the up days have greater volume than the down days, essentially, and that's an encouraging sign. Divergences are pretty meaningful, meaning that the market moving higher, but the on-balance volume sloping lower is often an indication of a divergence, a disconnect between price and volume. Now, Mark Chaikin, a couple years later, tried to improve on Joe Granville's work, and this is the story I've convinced myself is pretty good. This is, I think, the natural evolution of what we did, and he basically said, all right, looking at every day's volume and saying the entirety of that day's volume is bullish or bearish is kind of missing it. And Laszlo Barini and others tried to find different ways of measuring this as well. What Mark Chaikin did with the accumulation distribution is actually take the stochastics indicator and turn that into a volume reading. So it looks at where we closed versus the highs and lows of a particular day and use that as a way to weight the volume. So similar conclusions to what Joe Granville was doing, but just a better calculation, I would argue. Chaikin Money Flow actually takes that same calculation, but instead of doing a cumulative measure and adding it over time like the on-balance volume does, the Chaikin Money Flow actually looks at a fixed period. 20 days is our default, and it basically says over the last 20 days, where have we closed versus the highs and the lows, and then it weights the volume that reading. So it's kind of like a cumulative measure here, the accumulation distribution line. That's a good way to look at trends. The Chaikin Money Flow is kind of like an RSI for volume. It fluctuates around a zero line, and it's basically rotating around the zero level. So they are interesting to use together, I would argue, and I think depending on what questions you're trying to ask, that would tell you which one you want to use versus the other. By the way, if I glazed over a lot of the details of the calculation because I only have 2 to 3 minutes per question, but if you want to learn more about those volume indicators, how they're calculated, and some examples about how to apply them, click on the little magnifying glass, just type the indicator or type volume and go to the Chart School responses or the Chart School results, and you'll see some great articles on each of these indicators with all the formulas that are included, but also some really good examples that show you how you can use them to better understand price versus volume. That's my take on those indicators. Next one. Do you use daily or weekly charts to identify accumulation, markup, and distribution phases? This was actually a question that came from our live Q&A. We ended up getting into sort of the Stan Weinstein stage analysis. My own version of that is sort of adapted where I talk about uptrends, downtrends, and sideways markets, and just thinking about what phase the market might be in. The question really was added on to thinking of what time frame makes sense to really be able to label accumulation or distribution phases. And to be honest with you, I don't know if there's a right answer to that one. I think it depends more on your time frame. For me, it all starts with what time frame I'm trying to analyze. So for me, I'm trying to understand the next 1 to 3 months on average. And that's a generalization, but that's usually the time frame that I tend to think of for positions that I tend to, based on the time I'm looking at, that's about how far I'm looking out. And then after that, it's a little more cloudy, and I'm using, I'll wait to see how the market evolves before I can make a good sense of a good assessment of that. But having said that, I think the benefits of looking at multiple time frames are pretty helpful, right? This is a chart of, this is Tesla in our ACP platform. I had this before. This is the daily candle chart in the upper left. Here's the daily chart in the lower left, and then the weekly chart in the on the right. So if you think about it, right, we'll start with the daily chart, and if you bring it up here, like what phase is Tesla in? Well, I think again, it depends on sort of that time frame. But if I think about that, 1 to 3 month sort of time frame, I think you can see overall this is rotated from a downtrend phase, or what I call a distribution phase, in 2022 to an accumulation phase in 2023. And the reason why I would say that is if you take a step back from your monitor, we can see higher highs and higher lows. And most recently, arguably, we've put in a higher low. Now, within that, there are these shorter term waves. And this is what Bob Prechter and Ralph Elliott and others called the fractal nature of the markets, right? There are waves within waves. While I don't agree with all of Elliott's work, I do get that fractal idea that uptrends are comprised of shorter up and down swings, or what they call impulse and corrective moves. So having said that, I would say both, right? For the timeframes I'm looking at, there's a reason why my main ACP view includes the daily chart, which we just looked at, but also the weekly chart. When you look at the weekly chart of Tesla, you'll notice that it's actually not been going up, right? If you look at where we're at right now, and this is a tool, I forget what this is called. It's like the last clothesline or something. I forget what this is particularly called, but there's a really good feature on ACP where you can have a horizontal line that looks at the current price and just moves to the left. It is brilliant. One of the reasons why this show is called the Final Bar, because the final bar, the last bar, is so important, but understanding where we're at relative to the current price is really important. So look at how many times the price of Tesla crosses that today's price line over the last 2 to 3 years. A bunch of times, right? And then if you take a step back, you can see that this was actually a broader accumulation phase in 2020 into 2021. Now we've been in what I would describe as more of a consolidation phase, a sideways phase. But within that, there's distribution and accumulation. So I think for me, those phrases are very time agnostic in a lot of ways. I would think first about what time frame you were trying to operate on. Are you on a short-term swing trading time frame? Are you on a longer-term time frame in a retirement account looking years down the road, somewhere in the middle? And that's how I would try to assign some of those phases. For me, the daily and weekly charts are the charts that I look at to try to make that assessment. And if you don't know where to start, I would start there. Great question, by the way, and thanks for relating what we talked about in the Q&A, thinking about some of those stage analysis sort of disciplines. Next question, Dave, how do you use the volume by price indicator This is a really good one. I don't mean to sit on Tesla the whole time, so we'll go to Home Depot. So volume by price is actually a really cool, simple visualization. But what it allows you to do is overlay volume onto the price action. And so what happens, and both Sharp Charts, which we're using here, the ACP platform has a volume by price tool as well. Depending on where you're at, you obviously can use both of them. But what volume by price does is it basically turns it looks at volume over different price levels. So this is showing you how much volume was at different price points, right? How much volume was generated between these two extremes. And the width of the column here, just think of it like you turn the screen 90 degrees to the right. The width of this column or of this row is basically for these particular price ranges. Because I'm using a log scale, you can see that the ranges up here are a little smaller than these down here because it's looking at buckets of price. I think it's like $10 a bucket. So that's a smaller level up here because of the log scaling. So if you have an arithmetic scale, it'll look kind of normal, but here it looks like it's a little compressed, and that's all it's doing. It's looking at equal price ranges, dollar ranges, and then it's showing you what volume was within these different ranges. So how do you use that? That's what it's showing you. How you use it is the implication of this sort of analysis really goes to work by Pete Stoudemire. And following him, people like Robin Mesh, who actually, I wrote a book or I edited a book. It's been 15, 16 years now. It's been a couple. Robin Mesh actually wrote a chapter in my book, Applying Market Profile, which is a tool that Pete Stoudemire created. He was a trader in Chicago, and I'm fudging the story here, sorry, but a lot of, if you go to a lot of firms in Chicago, commodity type of trading firms, CTAs, a lot of them will use the market profile methodology. This is what Pete Stoudemire created. His idea was that the market moves in distributions, right? It creates a distribution and then it moves to a new level. And then it sort of creates a bell curve, a distribution of over and undershooting that sort of level, and then it goes to a new range. And Robin Mesh, I think, really built on Pete Stoudemire's book brilliantly, thinking about how to apply it to different asset classes, different timeframes, and things like that. But it goes back to Stoudemire's work about distributions and trying to think about how prices are distributed, how volume is distributed across the time frame that you're looking at. I will point out a couple things. Number one, it is dependent on what time frame you look at. So depending on what time frame you set, the distribution is going to be looking different because it's based on what's on the visible area at any given point. The general idea is places with heavy volume tend to be a concentration of prices, tends to be an important support level. So the idea was something like Home Depot, looking at the last year here, is you see a concentration of heavy volume sort of in this range, kind of the 280 to 295, we'll call it range, and also a little bit more up here, sort of in that 310, 315. The general thinking is if we sell off here, you look to the left and find the price levels where you have a lot of volume. That's where a lot of shares have changed hands. Just like with traditional support and resistance, the idea is you could expect further support because that's where shares have changed hands before. So you assume going forward there's going to be a similar type of thing. And what this chart definitely tells me is this range down here really meaningful. So if and when Home Depot would rotate lower, that would be a really clear level of support based on pure price analysis, but also the concentration of volume right around those areas. Next question, Dave, why does the market summary page show bond yields as 42.72 instead of 4.272? Really good question. So if you go to our market dashboard or your dashboard page and click on the bonds tab here in the market overview section, you'll see that the yields are quoted basically at 10 times their value. So the yield on the 10-year Treasury bond is currently 4.173. These indexes that we're quoting are pretty widely followed in the industry. This 10-year point is the ticker's $TNX, the 5-year point $FVX, and the 30-year point $TYX. You can see the tickers up there. But basically, these are coming directly from the CBOE, as you can see there. Now, the CBOE is an options exchange, of course, based in Chicago. So they're quoting these yields at 10 times because that's the price of the underlying option. So they're actually quoting the option price that is used to calculate the option change for the 10-year yield. The methodology or the way that it actually comes out in terms of a dollar value is to quote it at that price point at a 10-time yield. So what most people do, me included, is just look at 41.73 and just realize that that is 4.173. why can we not just change it and have it be 4.173? Great question. That's the convention in the industry, and as with many things, that's just what people have done so much that that's what we're all expecting to see, myself included. If it was quoted differently, I'd probably get a little bit confused. Now, we do have yield indexes that track the actual yield, so if you want to see those and be able to use those, you can. So, for example, the 10-year yield. Right here, $UST10Y, and if you use that syntax, you can do 5Y, 30Y, 2Y, whatever it is to look at different maturities, and it'll be quoted just as you would probably expect. Just to finish off, Dave, I don't see a clear-cut correlation between price moves and big volume. Can you explain? Yeah, really good question. I think we touched on volume in a number of other questions so far today, so that's great. I'm glad we've been able to dig a little bit into this topic. Your comment was basically saying, what's the story between big moves and heavy volume? And I think it goes back to, again, if you the literature I would point you to, John Murphy's classic book on technical analysis. Martin Pring, of course, has written one of the most heavily used books on technical analysis. Edwards and McGee came a couple years before that, written in like the 1960s. Called Technical Analysis of Stock Trends. I would go back there as well. And what all of those books will tell you is that big moves on heavy volume are more meaningful, or assumed to be more meaningful, than big moves on lighter volume. Now, what I'm doing right now is overlaying the daily volume bars over the price bars. And you can also color code the volume. There's this little selection that says color volume. I like to have that switched on. I would encourage you to do it as well, because what it's basically just doing is, if it was an up close, then that bar's volume is black. And if it's a down close, that bar's volume is red. So it's easy to glance down and see if the heavier volume days have been on up days or down days. The problem, I think, in 2023 is, I would say the volume now means something different than it did 50 years ago. I think when a lot of those books were written back then, institutional investors had a lot more access to information that others didn't. The idea of following the big money and recognizing big shifts in price on heavier volume and knowing that you were making bets along with the big investment shops was more meaningful. That still could be a goal of yours, but I would say the ability of volume to represent that is a little less, because a lot of the volume is done off the exchange and things like dark pool. So it's not all done at a post on an exchange, which it used to be done. So it was easier to recognize and reconcile trades and individual volume readings. A lot of the volume is not institutions, right? It could be hedge funds, trading and hedging, and that is represented in the volume figure as well. So I'm less keen on volume representing what I think it traditionally had, and that's why, to be honest with you, I don't show volume on most of the charts that we look at on the Final Bar and a lot of my work, because I've gotten away from that. I will tell you, when I do look at volume, I use some of those indicators that we talked about before, and particularly I'm a fan of the Chaikin Money Flow and Accumulation distribution, both of which are included on the StockCharts platform for everyone, because I think those do a much better job of looking at trends in volume. I think that's really the most important question you probably want to be answering. But that is how you can overlay volume. That's what you're looking for. Big moves, are they on up or down days, those heavier volume days? And do you see a move in the stock that's not supported by heavier volume? The implication is that it is maybe something you want to put a little less value on. We need to wrap the show, folks. Great mailbag. Thanks for those questions. Each one of those could be a whole hour webcast, so I tried to summarize as best as I could. We've got to go right to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Chart of Tesla, pretty important. I think all the Magnificent 7 charts are ones to follow, and they're on the front of my market dashboard for that reason. Tesla is an interesting one going into this weekend, because we rallied right up to the 50-day and came down. If you asked me to sketch out what would a bearish rotation look like for Tesla, I would probably gap down off of a new swing high. I would break below the 50-day. The momentum would get really negative. We'd rally up to the 50-day and fail to break above it as the momentum tops out around 60 for the RSI. All of those things that I just mentioned have now happened. So it is giving definitely the feel of a bearish rotation, in my opinion. It's down about 5% today, maybe a little bit more going into the close. Note that about half of the S&P still below its 50-day moving average. 53% of the S&P still below their 50-day moving average. So this is another indicator to watch as well, to see if others pull a Tesla and fail to get above their own 50-day moving average. Chart number 2, traditional look at offense versus defense. I love this sort of ratio because it's simply things you want versus things you need. Are consumers spending on discretionary purchases, things like a new watch, a new house, travel, tourism are all in there versus things you need, cleaning products, household goods, beverages, and all that sort of thing. This ratio is a really good thing because it's not just about what consumers are doing, but it's expectation about those companies that produce those goods that we and services that we mentioned. So the fact that the equal weighted ratio is making potentially a new high for the year here, and really a new multi-year high, I think is pretty important. That ratio continues to go higher. This is a risk-on feel to this chart, and I think broadly speaking gives the implication of more of a risk-on feel to the markets as a whole. Finally, Paramount Global, one of those stocks gapping lower today, finished today down 9.5%. I had to keep refreshing my chart as the day was going on because the price kept going lower. Gapping lower, but closing at the lows of the day. It's all down almost 10% today. Now, the reason why I just wanted to highlight this chart is because even though the gap lower might be frustrating if you're looking at the stock, if you're holding it and you're getting crushed today, probably doesn't feel particularly good. I think this is a great cautionary tale of the dangers, the risks involved in buying stocks making new low. This is one of those falling knife kind of stocks. Note how after we made a new 52-week low in May, we rotated higher to around 17 and then failed to get any higher. So we're not making new highs. We're actually making lower highs and lower lows. We made a new low, a new swing low in August. We rotated higher around 15. So the fact that this gapped lower may be a surprise. The fact that the overall trend is down should not be a surprise. And that's why I think focusing on the bigger picture trends, watching when stocks are below 2 downward sloping moving averages, that can help you avoid dangerous, risky areas like Paramount Global and others making new lows. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. Make sure you check out all of our previous episodes, some really good interviews recently. And Monday, we have a special episode, Top 10 Charts to Watch for September 2023. So don't miss my conversation with Grace and Rose. Have a great Labor Day weekend. We'll see you next week.